Wow, this is completely crazy. Just look at this unbelievable market whiplash we've been seeing. We are talking about ServiceNow, right? This is a massive, highly established blue chip tech behemoth, and yet it is swinging wildly out there like it's some brand new speculative meme coin. To really put this into perspective for everyone watching, imagine you took a hard-earned $10,000 and you decided to invest it into ServiceNow stock right at its 52-week high of $211. Within a shockingly short window of time, you would have been staring down the barrel of a terrifying 40% plunge. Literally, you are suddenly down to $6,000. Your stomach completely drops, you are questioning all of your financial life choices, and if you turn on the TV, the financial media is practically screaming that the sky is falling and legacy software is dead. But then, almost as if someone flipped a switch overnight, the stock surges right back up, ripping 14% higher in a single month. I mean, seriously, how does a multi-billion-dollar enterprise software company experience that kind of extreme violent volatility? Is ServiceNow about to be entirely disrupted, gutted, and destroyed by artificial intelligence, making it the ultimate AI victim? Or is management quietly positioning this company to be the ultimate AI victor? Welcome to today's Explainer. We are absolutely not just going to read you the flashy clickbait headlines today. We are going to tear open the actual financial statements, look at the hard data, and find out exactly what is going on behind the scenes.
Okay, so let's dive right into this. Here is our roadmap for today's Explainer. First, we are going to start by uncovering what is really driving the recent stock news. Second, we will get into a hard financial and fundamental deep dive. Third, we are going to examine the broader industry trends and figure out their economic moat. And finally, we will lay out 3 specific future survival scenarios for the stock. I am joined today by our chief investment analyst to break this all down logically. Doctor, are you ready to jump straight into the cold, hard data?
Absolutely. I have the official Q1 financial filings, the latest institutional buying and selling data, and the Simply Wall Street valuation models completely parsed and ready for analysis. If we look at the numbers, the picture becomes very clear. Let's get started.
Perfect. Let's move right into our first section, behind the stock news. We really need to get this bizarre market whiplash explained.
Now, I have to play devil's advocate right out of the gate here. As we just discussed in the intro, this stock dropped 40% from its 52-week high. We saw it tumble a massive 18% right after its Q1 earnings report in April alone. I mean, as a retail investor watching my stock account bleed out, that kind of instant drop signals pure panic. You don't just see a massive sell-off like that for no reason. But then, it suddenly surges 14% late in May. This doesn't make any sense to me. What on earth is driving this bipolar behavior from Wall Street?
The data on this chart proves that it is actually a very logical sequence of events. What we are witnessing is a massive clash between a Wall Street narrative and fundamental reality. The broader market is currently obsessed with a singular, overarching thesis regarding artificial intelligence, and that specific thesis created massive short-term distortions in ServiceNow's valuation. We have to separate the emotional market voting from the actual financial weighing. It is proven by the financial data that the initial crash in April was completely divorced from the company's actual cash flow generation and operational health.
Wait a minute, doctor. Divorced from reality? If it was so divorced from reality, then why did literally everyone hit the sell button at the exact same time in April? That doesn't just happen in a vacuum. It comes down to these 3 specific triggers documented in the market data. First, we have market fear. For months, the institutional market had been operating under a terrifying thesis. AI is going to disrupt software as a service. The underlying assumption was very straightforward. If large language models can simply automate enterprise workflows for virtually zero cost, why would major cost-conscious corporations keep paying premium subscription fees to a legacy software platform like ServiceNow? That specific fear of obsolescence is what directly caused the 18% post-earnings drop. However, trigger 2 was the reality check. The actual Q1 metrics were objectively strong across the board, and management boldly authorized a massive $4.2 billion share repurchase program. The historical data proves you simply do not authorize a $4.2 billion buyback if your core business is collapsing under the weight of AI disruption. Finally, trigger 3 occurred when Bank of America Securities analyzed the same data, reinstated coverage with a buy rating, and assigned a $130 price target. This formally shifted the institutional mood back to positive, creating that surge. Okay, so what you just said basically means the market had a massive, irrational panic attack, thinking ChatGPT was going to steal all of ServiceNow's corporate customers overnight, until the actual bank data and the company's own cash proved that they were still making money hand over fist. But before we get too deep into the financial weeds here, let's take a quick step back for viewers who might not follow enterprise software closely. That sector can be way too complicated and full of buzzwords. Could you give a very simple analogy? What exactly does ServiceNow actually do to make all this money?
Think of it like this. ServiceNow operates as the central nervous system for a large company's daily digital chores. If a new employee gets hired and needs to reset a password, request a new company laptop, complete HR onboarding paperwork, or route a complex customer service ticket to the right department, ServiceNow is the software platform that manages and routes every step of that workflow from start to finish. According to their official platform data, they have more than 95 billion workflows running on their system each year. They essentially connect IT, human resources, customer service, and security operations onto a single, unified pane of glass.
Oh, I see. So they are essentially the ultimate digital middleman, making sure the entire corporate office doesn't just fall into total chaos. Honestly, without them, most Fortune 500 companies would probably still be routing IT requests through sticky notes on monitors and lost email threads. That makes total sense now. Let's move into Section 2, Financial and Fundamental Deep Dive, where we see the actual fundamentals revealed. Okay, so they organize digital chores for huge companies. Got it. But here is my sharp, contrarian question for you, doctor. If they are this completely irreplaceable central nervous system, and they are making so much money, why exactly did the stock price crash so aggressively in April? If the fundamentals are truly bulletproof, why didn't the market believe it? Show me the actual numbers that prove this company is resilient against the AI wave, because right now, I'm just hearing promises.
Let me break this down for you based strictly on the figures from their Q1 financial filing. According to the exact metrics reported, the underlying business is demonstrating exceptional strength despite the market's panic over AI. For starters, management actually raised their outlook for 2026. They are officially projecting subscription revenue to hit between $15.74 billion and $15.78 billion. Furthermore, if you look at the profitability metrics, they are operating with a staggering gross margin of roughly 76.6%. To interpret that number for you, in the highly competitive enterprise SaaS universe, maintaining a gross margin above 70% while scaling at this massive size is exceptionally rare.
Wow, wait, a 76.6% gross margin? That means for every single dollar they take in from these massive corporations, they get to keep over 76 cents before they even pay their operating expenses?
Exactly. And it is that exact margin profile that leaves them plenty of room for continued aggressive investment in their own proprietary AI and security infrastructure. They don't have to borrow heavily to innovate. More importantly, while speaking on the Knowledge Conference stage, management confidently reiterated their long-term target. They expect total subscription revenue to exceed $30 billion by the year 2030. If we look at the trajectory, these are not the metrics of a company being disrupted by AI. These are the metrics of a company actively expanding its total addressable market.
Now, what's really interesting about this slide is this stark contrast. You have the market fear on one side screaming that AI will kill their subscriptions, and the hard financial reality on the other side. But wait a minute, doctor. The slide mentions returning capital above cost. What does that actually mean for our stock accounts? What does that mean for the retail investor sitting at home right now, looking at their brokerage app, trying to decide if they should buy the stock today?
According to Simply Wall Street's fundamental analysis models, ServiceNow generates stellar operating margins alongside very solid revenue and earnings per share growth. But the most crucial metric for long-term shareholders is the return on invested capital, or ROIC. The financial data proves that ServiceNow is consistently able to return capital above its estimated cost of capital. In practical terms, this means that every single dollar they reinvest into their business, whether that is building new AI tools, hiring top-tier engineering talent, or acquiring smaller strategic companies, is generating a positive, compounding return. They aren't just burning cash to stay relevant in an AI world. They are systematically destroying the narrative that AI will erode their workflow moat through incredibly disciplined profitability.
Okay, but look, talk is cheap. Even projected revenues for 2030 are just optimistic projections drawn up by executives in a boardroom. Where is the hard, undeniable proof that management actually believes their own optimistic story?
The undeniable, fact-based proof is right here on the screen, $4.2 billion. In conjunction with their strong Q1 results, ServiceNow's board of directors authorized a massive $4.2 billion share repurchase program.
Oh my God. $4.2 billion just to buy back their own stock right in the middle of a global AI panic?
Yes. It is a classic case of management putting their money where their mouth is, while retail investors were busy panicking and selling. It is proven by historical market data that when a management team allocates that level of capital to buy back shares, it acts as a massive floor of support for the stock price. It forcefully signals to institutional investors that management fundamentally believes the stock is undervalued relative to its future cash flows. This action completely contradicts the market's initial fears that the business model was broken.
Let's move to Section 3, Industry trends and economic moat. Let's talk about how they are building this so-called AI moat.
So what you just said basically means management put $4.2 billion of their own dollars on the table to prove the market wrong. I absolutely love that. But throwing billions at a stock buyback only actually works if the core business is truly protected from obsolescence. What is ServiceNow's unique, irreplaceable weapon in the age of AI? How are they defending their turf against trillion-dollar giants like Microsoft and Google who are pouring endless money into this space?
Their irreplaceable weapon is what they have officially dubbed the AI Control Tower. At the recent Jefferies Software, Internet, and AI conference, Finance Chief Gina Mastantuono explicitly stated that ServiceNow sees itself as the governance layer for the era of agentic AI.
Wait a minute, Doctor. Stop right there. Governance layer, agentic AI, that is way too much technical jargon for a Tuesday. Speak to me in plain English. What does that actually do?
The technical specifications show that ServiceNow does not actually need to build the smartest AI brain in the world to win this race. Instead, they built the newly introduced Model Context Protocol Server. This system allows external AI agents, like Microsoft Copilot or Anthropic's Claude, to execute controlled actions safely inside a corporation's private network. In simple terms, no matter which AI language model a massive enterprise chooses to use, ServiceNow acts as the toll booth and the security guard. They profit regardless of who wins the AI wars, because they are the core platform orchestrating, securing, and governing all of the data flowing between these external models and the company's internal systems.
Oh, I get it now. They are the toll booth for the entire AI revolution. That brilliantly illustrates why they aren't scared of ChatGPT or anyone else. But how did these specific chronological events on the timeline drive the big institutional buyers back into the stock in late May?
The timeline clearly shows a dramatic shift in market sentiment based on verified events. In April, retail and algorithmic fear drove the price down. But in May, ServiceNow expanded massive, revenue-generating AI partnerships with Wipro and integrated with Experian Ascend. Wipro is actively rolling out these automated AI workflows across global customers in IT, HR, and customer service. By May 27th, the governance pitch at the Jefferies conference solidified their strategic position to Wall Street. And if we look at the exact institutional data from the recent filings, the buying was hyper-aggressive. Vanguard increased its position by a staggering 404.5%, scooping up nearly 102 million shares. The Commonwealth of Pennsylvania Public School Employees Retirement System boosted its stake by 383.1%.
Wow, so let me get this straight. The big institutional boys were quietly buying up the dip at a massive discount, essentially quintupling their positions, while everyday retail investors were panicking and selling?
Precisely. The data shows institutional investors now control about 87% of the outstanding equity. The smart money recognized the AI control tower strategy, saw the intrinsic value, and capitalized heavily on the market's mispricing.
Okay, so they have a massive moat with their AI control tower, and these partnerships are clearly paying off in a huge way. But we have to be completely objective here. Nothing is perfect, and every single company has cracks in its armor. What are the fatal weaknesses? What could actually derail this massive $30 billion growth story?
As a rational data analyst, we must heavily weight the risks cited in the Q1 filings and flagged by Simply Wall Street's algorithms. First, there are significant integration costs associated with their recent aggressive acquisitions. Specifically, the data indicates the Armis acquisition is expected to create a 75 basis point headwind to the fiscal year 2026 operating margin and a full 200 basis point headwind to the free cash flow margin.
Wait, so buying all this future growth is actually hurting their short-term profitability today?
Correct. A 200 basis point hit to free cash flow is a very meaningful drag on any valuation model. While management expects this to normalize by 2027, the short-term margin squeeze is a real mathematical risk. Secondly, the Q1 report explicitly flagged geopolitical drags in the Middle East, which negatively impacted their highly lucrative on-premise software deals. And finally, Simply Wall Street data flags recent significant insider selling over the past 3 months as a key risk indicator. When corporate executives are selling their own shares, investors must carefully weigh that action against the incredibly strong AI growth narrative.
Section 4. Future survival scenarios. Let's look at the bull, base, and bear cases to see where this is all heading.
So we have margin headwinds from acquisitions, global geopolitical risks, and executives actually selling shares. That is a very sobering reality check. What does all this data mean for the future of the stock? Doctor, lay out your 3 survival scenarios. Give me the specific, strict preconditions for where this stock is headed based on the current data.
Based purely on the technicals and fundamental valuations, here are the 3 highly probable scenarios. The bull case assumes AI hypergrowth materializes directly through the Wipro partnership and the Armis integration margins normalize smoothly by fiscal year 2027. If they execute this flawlessly, the stock drives toward the analyst consensus target of $142.50.
And what is the most likely middle-of-the-road base case?
The base case assumes they simply hit their stated $15.74 billion guidance and execute the steady $4.2 billion buyback without any major hiccups. In this scenario, the stock holds the heavy technical floor at $120, a level that showed massive historical support on heavy volume of 68.24 million shares. However, the bear case is where the identified risks materialize. If integration costs create a prolonged margin squeeze, or if macro tech spending drops across the Fortune 500, perhaps signaled by weak ISM manufacturing or services PMI data, the stock will fall through that support and trend downward toward the Simply Wall Street fair value model of $108.81.
Now, what's really interesting about this slide is the massive spread. You have Simply Wall Street saying the fair value is just $108.81, meaning the current price of $124 is actually a bit overheated. But the analyst consensus is way up at $142.50. Why is there such a huge, glaring disagreement among the experts on what this company is actually worth? The spread exists almost entirely because of the premium valuation multiple attached to the stock. ServiceNow currently trades at a price-to-earnings, or PE multiple, of around 59. That is incredibly steep by traditional financial measures. The Simply Wall Street model relies heavily on disciplined, current profitability and compounding revenues, arriving at that much more conservative $108 fair value. To justify a 59 times PE multiple and hit that aggressive $142 target, the company requires absolutely flawless execution over the next several years. They must empirically prove that their AI control tower drives tangible subscription growth toward that $30 billion target for 2030, and they must do it without letting share-based compensation overly dilute their existing equity holders. So what you just said basically means there is absolutely zero room for error here. They are priced for perfection, and any stumble will be punished severely by the market. You know, looking at all this data, a famous quote by the father of value investing, Benjamin Graham, comes to mind. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. That perfectly encapsulates ServiceNow's exact situation right now. That initial terrifying 40% drop was purely an emotional vote of fear that AI would destroy their business model. But that sudden 14% surge, that reflects the heavy, undeniable weight of actual Q1 cash flow, a 76% gross margin, and a massive $4.2 billion stock buyback. So, the absolutely crucial point we have to leave you with today is this final question. Will ServiceNow's brilliant AI control tower strategy actually justify that sky-high 59 times PE ratio? Or will the harsh reality of acquisition margin headwinds and geopolitical risks drag this stock back down to test that $115 to $120 floor? That is the ultimate test of trust for any investor looking at the stock today. Thank you for watching today's Explainer. We hope we helped you cut through the noise and see the real data. Your subscriptions, likes, and supportive comments are a huge encouragement for our Explainer production, and we want to hear from you. Drop your own analysis in the comments below.